You're listening to The Real Investment Show.
So actually this morning I have two rants. We'll get to both of them this morning. When the markets are going up, we saw this in 2020, 2021. We're actually seeing it again today, right? There's a lot of stocks that are up 100% from their lows back in October. Now, that's not saying a whole lot, but there's a lot of stocks that are have risen sharply because speculation is coming back into the markets in a variety of different manners. And one of the issues though, and again, there's all these stories. We've told stories before, like in 1999, Dallas, the Dallas Morning newspaper. They would get a longhorn steer out and they tape this grid off on the ground and they'd put stock symbols in the grid, and wherever the cow pooped, that was the stock pick, and the longhorn steer outpicked the pros because that's the market we were in. There's another story about a blindfolded monkey that was a better stock picker in 2001 than the pros. And that's what happens though when you get into these kind of speculative environments and where things are just kind of going up and money's just chasing things at willy-nilly. But the other problem that comes in from the markets is that in order to sell product, right? Advisors and Wall Street in general, they make things overly complicated because the whole goal is you're too stupid to manage your own money. You have to use these really sophisticated, complex models of all these different funds, and you have to have this type of allocation structure, et cetera. And that's not really necessarily true. I'm actually writing an article I told you yesterday on conviction and how conviction to an idea like the world's going to end or the dollar's going to go to zero, whatever it is, can really put you on the wrong side of the trade. And, it's kind of the same thing that was used for a long time in the markets as well. You have to own a little of everything. You need diversification, right? You need to have all these different assets to make sure you're diversified, because that way, if the market goes up or down, you kind of participate, but you don't get hurt. And that sounds great in theory until the turn of the century when we had blindfolded monkeys and longhorn steers picking stocks. And correlations pretty much went to one. It didn't really matter what you owned. Everything went up together. Everything went down together. Since 2009, being diversified in anything other than the S&P 500 or the NASDAQ has cost you money. If you've had emerging markets or international or gold or anything else, you've deteriorated your returns over time because all the money flows were going into the United States. So, the point is that investing doesn't have to be complicated. But in order to sell you stuff, and I hear these advertisements on radio and TV all the time, it's like, you need to have this structure and that structure, and the world's too complicated, and you're not smart enough to manage your own money. And that's why you have to have us, right? That's why you have to have us manage your money. And the reality is that managing money in a portfolio is not difficult, and it's really not complicated. You just have to pay attention to what's going on. And that's why we talk about technicals and those type of things. These aren't complicated issues. It's just things that you have to pay attention to, and then overlay that with a really strong financial plan so you have a goal of where you're actually trying to get to. The reason that people take on too much investment risk over time is because they don't really have an end goal. They're just like, I know I need a bunch of money to retire, so I'm going to take on all this risk right now so I can have all this money to retire, but they really have no idea if it's $1 million or $2 million or $10 million. And Danny will tell you, and he will tell you here in a second, we have people that retire on $500,000 a year or $500,000 in assets, and they retire just fine. And then there's people with 10 million assets that can't retire, right? So it is a function of your underlying lifestyle. But not having that goal of where I need to get to pushes us to take on too much risk. And risk is a function of how much money you lose when you're wrong, not how much money you make, right? And so investing isn't complicated. And we look at a lot of portfolios that come in from other places all the time, and it's like, what do you got going on? I mean, another big mistake and I'll turn it over to Danny here, but another big mistake on diversification is I'm going to have 10 different people manage my money. I need it diversified. That's a terrible idea. And the reason is that you don't have any correlation between what all these different advisors or managers are doing for you, and you create a bunch of overlap risk because they pretty much all wind up owning the same thing. So there's just a variety of issues that you really need to pay attention to. Simple is often better, Danny.
Well, I agree, and I think I've seen some that are give you the illusion of being simple because maybe there's not a ton of positions. And ideally, we don't want a portfolio with several hundred positions, which I do see. We see this. There's a handful of really big firms that will buy all of these positions. And at some point, you're just tracking the market. And then the fees add up because typically they're they're charging you a fee. Then they're hiring an outside money manager that charges you another fee. We see that a lot too, right? So you see a lot of overlap. That can be an issue because why not just go buy SPY or go buy, which is something we've owned in the past, just an S&P 500 ETF. I mean, there's a lot of ways to play that game. Now, you want to be cautious because I do see this with a lot of mutual funds as well. And we lose a lot of tax efficiency with mutual funds and some control. But, I visited with somebody yesterday and they had a portfolio which ideally didn't look overly crowded, meaning that there wasn't 100 positions or several hundred or even, 50 or 60. But what it was is a lot of mutual funds that were very similar. And this was a wrap account, but some had A shares, so transactional shares, right? You're paying an upfront fee. Some had C shares, which are really expensive, right? You start getting into the internal expense ratio is pretty high. Like we started looking at just kind of playing devil's advocate, looking through all this, said, man, this one's 1.4, this one's 1.6, this one. And so that's on top of a management fee. So now the hurdle has become that much higher for you to succeed. And so our goal is to make sure we keep costs down. We're always acting as a fiduciary. We are, if we're trading in somebody's account, we're not getting paid for it. We believe it's because it's going to protect funds or grow them. But I think that we have to be mindful. And when we look at some of these portfolios, this is somebody who, was somewhat moderately aggressive, I would say, and had bonds, but all the bonds were high yield. And, in different environments, they're going to trade just like a stock.
Right.
And so not nearly as risk adverse as what, when you look at a portfolio breakdown, is what it would elude. So we have to be really cautious when looking at this. And look, in any advisor's defense, it's easy to pick apart a portfolio. You can pick apart anything, right? Yeah. I mean, and say, hey, here's good, here's bad, here's why. Everybody has a little bit different flair to it or what they're trying to accomplish or do. And there's many different ways to get there. But I think where, you mentioned the over-sophistication. You get a lot of these places that they create product for the next biggest thing or for the thing that was big last year, the idea, the theme, whatever it may be. And, hey, we're going to have this account, this account, this account. And it's difficult sometimes to understand how it all works together. And so I think this is where, you mentioned a financial plan, taking that inventory of assets, understanding how asset allocation works together. And I don't mean just diversification, right? Because that's what you're always going to hear. You got to be in large cap, mid cap, small cap, international, emerging markets. And then, we'll tweak it a little bit if we don't like that area. We'll reduce it by 2 or 3%. If we really like it, we'll overweight it. Well, if you don't like it, why are you in it?
Yeah. Well, and again, this is analysis. Look, there's a tremendous number of really great advisors out there. So don't take this as a blanket statement that all advisors do this, because that is not the case at all. But I think the things that you have to just ask yourself is that if your advisor is putting you into a lot of mutual funds, right, and the thesis is buy and hold, why do you need an advisor? If you're just going to buy and hold mutual funds, which all have managers, right?
Well, that's the kicker, right? I mean, we look at a lot of them, and they haven't traded in years.
Right. And so what are you paying the advisor for? Well, I'm paying for the financial plan. Okay, that's fine. There's nothing wrong with that, as long as you're okay with the buy and hold structure. And it's just things to think about, is saying, okay, look, what am I paying for and what am I actually getting? And, there's just been a lot of development over the last 15 years, 20 years in the markets, which prior to 2000, advisors were paid to manage money. This is what we did. And we were paid to track the market and make investments in these type of things. And then after 2000 really came this evolution, particularly of the younger advisors that were coming into the markets and and the big brokerage firms, right? The JP Morgans, the Wells Fargos, et cetera. They said, forget all that, right? Because we started going to decimalization of the markets and commissions were cut and all this type of stuff. And so it made it much less profitable to manage money, right? Why am I going to pay Danny, $500,000 a year as a salary as a portfolio manager or whatever he gets paid to manage that portfolio when I can just get rid of him? And we come up with these models where just say, pretty much you're in this model of 15 different mutual funds. You'll kind of track the market up or down. And the premise is you just kind of buy and hold. And that eliminates the whole need for having to have sophisticated portfolio technologies and all these type of things that cost money, right? It reduces that cost. So as fees came down, the market environment, Wall Street came up with ways to cut the cost to keep that profitability on you, right? So this is the important thing to consider. So, just the point of the conversation is just be careful, make sure that you're, the value of what you're paying for is there. And if it's not, there's other alternatives. And again, there's nothing wrong with doing it yourself. Managing money isn't hard, right? You just have to work at it. Well, it's like anything else.
Yeah, but it can be extremely overwhelming. I mean, think about how many vehicles there are to invest in. I mean, there is a different type for everyone. And determining what's best for each person is probably difficult. Without, I think we take it for granted because we're in the weeds every day.
Right.
But most people aren't.
But this is where you go back to a good financial plan too.
Correct.
Yeah. All right. Second rant of the day coming up right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
So, I got a little rant today. I've talked before about the myth of stock buybacks being a return of capital to shareholders because, again, if Apple buys back their company stock, did you get a check in the mail? Right? Did anything show up in your account because they sold, they bought back company stock? No. Now, dividends are a return of capital to shareholders. Why? Because you actually get a check. Right? If you're in a DRIP program, a check shows up in your mailbox, or you have a deposit into your bank account. That's a return of capital to shareholders, right? Buybacks aren't. What buybacks do, though, is increase the wealth of corporate insiders, and the SEC is now taking some aim at this. They are now reviewing what's called the 10b5-1 rule, and this is a rule that affects individuals of insiders of corporations when they buy back stock. And what you're supposed to do, and this is just very quick in a nutshell, there's a Wall Street Journal on this if you just Google 10b5-1 Wall Street Journal. What you're supposed to do as insiders, you file a plan. And Danny deals with this from time to time with our clients as well. But you have to file a plan that says, I'm going to execute the sale of my shares over this time frame, right? On certain periods, I'm going to sell my shares, et cetera. And you have to follow this plan, right? And then you're supposed to follow the plan.
They typically only have certain windows as well when they can do so.
Right. And you're supposed to adhere to this plan. Well, what the SEC is now reviewing on this rule is that I'll just clip it for you. Among the highlights, officers and directors will have to wait at least 90 days after starting or modifying 10b5 plans. Some insiders were selling shares less than a month after adopting their plan, sometimes even the same day, or adopting and initiating trading plans right before earnings announcements. Wink, wink, nudge, nudge. Like they have no idea what they're about to announce. Another trick has been to adopt multiple 10b5-1 plans and later selectively cancel the ones that wouldn't work to the insider's benefit. You get my point? Right? So SEC is aiming to change this a bit. But this goes into another picture, and this now you have to jump with me for a minute. It goes into climate change.
And here's the rant.
Poor people don't care about climate change, right? Look at who are the biggest polluters in the world, right? China, India, South America. It's where the majority of poor people live. They don't care about climate change. They're just trying to make ends meet, right? They're just trying to feed themselves. They don't care about climate change. Who cares about climate change? Rich people. Why? Because there's a massive amount of money in climate change. And for companies involved in that, I gave you an example. My wife sells LNG. And so they have what's called bio LNG, which is LNG that is produced from pigs and other type of poop, right? And so it's natural and organic and whatever. Anyway, it's climate friendly is this bio LNG because you're not harvesting it out of the ground, right? So this is supposed to be better for the planet. Well, if I want to get the bio LNG from point A to point B, I've got to do what with it? I've got to put it into a pipeline with every other LNG that's in there. So when I get the pipeline, the gas at the other side, unless I truck it, right, then that's a different story. But the point of it is I get what's called a carbon credit. Now, I've explained carbon credits to you before. Danny has a company. He's from West Virginia, and he has a coal mine. The worst. He doesn't even do clean coal mining anymore, right? He's doing it the way they did back in the 30s. I mean, it's just the nastiest form of coal mining on the planet. I mean, he's just destroying the planet. He has a zero carbon footprint. How does he have a zero carbon footprint? He's doing he's mining coal, picks and shovels and the worst kind, right? He's not even close to clean because he buys carbon credits. So companies like Tesla that have a, environmentally friendly footprint, they get carbon credits that they can then sell to Danny so Danny can reduce his carbon credits. Okay, let me explain to you this in real life. There is a company that is cashing in on climate change. One of the most important technologies to address climate change got a boost on Thursday when a startup said it pulled carbon dioxide from the air and stored it underground. The company has cashed in. You're hearing the words here? The company has cashed in on the effort, potentially creating a viable business model that could kickstart a brand new industry. ClimateWorks AG is the leader in the race to remove carbon dioxide from the atmosphere using a process known as direct air capture. This all sounds good. Customers include Microsoft, who paid a significant premium. Pay attention to this line. They paid a significant premium to buy carbon credits guaranteed and generated by ClimateWorks. So how does ClimateWorks make their money? Selling carbon credits. So who's the beneficiary of climate change? Rich people. That's why there's a ton of money to be made selling climate change. Now look, I'm not against doing things that are good for the atmosphere, but let me explain to you the ClimateWorks function, how this is what this company created. They created a box that basically sucks the air out of the atmosphere, right? It then strips out the CO2 and then produces CO2-free air on the other side. It then stores the CO2 in a filter, and then they heat it up to several hundred degrees, and it crystallizes it. Then they pump it underground where they can be stored there for thousands of years. Now, there's a much cheaper way. By the way, the whole heating process required another energy company to produce the electricity to create the heat. But there's a much better way to do that. If I want to remove CO2 from the air, plant a tree. That's what trees do. They need the CO2 to take in the CO2 and produce oxygen, right? That's how we all live and breathe. Guess what the problem with that is, though? Trees don't produce carbon credits, and they don't produce any revenue. And they're cheap to plant. So the point is that, this is all great technology, right? I got nothing against it, but the scam in this is the carbon credits. I produce a technology that doesn't really lower the footprint of what's going on outside of what planting trees would do. And I make billions of dollars. Now, who's going to benefit from this? Corporate insiders, corporate executives, et cetera. It's all great, right? And
people creating the pollution.
And people, yeah.
In their private jets.
Exactly. Bill Gates says that he should be allowed to have his private jet and fly over the world and do this because he's contributing to reducing climate change. So his carbon footprint doesn't matter. It's a net cost. The point is that this is part and parcel, and then goes back to this whole 10b5 plan, et cetera, corporate insider. This is why people hate capitalism today, If you look at TikTok and all these other social media channels, there is one person after another, disparaging capitalism. Capitalism is evil. I saw a TikTok guy the other day talking about how capitalism is killing people. No, capitalism isn't killing people. Now, the guy's dressed in a T-shirt with shorts, sitting in his mom's basement, disparaging capitalism. Another guy was out yesterday as well talking about how he shouldn't have to work. Right? There should be free health care, should be free food, free basic essentials. You should be able to live your life without working. If you want more than the basics, then you work.
Who's going to provide that, though?
Well, this is the illogic of all of this, right? But the point is that, when we go back to look at the core structure of 10b5 rules and insider buying and stock buybacks and corporate, and these climate change credits and all these things, when you actually dig down to the core of all of this, it all has to do with making money. Guess what? That's capitalism. But this is the thing to understand. So look, if you really want to cure climate change, if you really want to reduce CO2, go plant some trees. It'll work a lot better.
Feel better?
I feel better. I had to get my rant
Good
off
job.
this morning. It just, these things just infuriate me because as soon as you start reading the first line and it says, creating a viable business model that could kickstart an entire new industry.
Yeah.
That tells you all you need to know.
Here we go.
So anyway, we'll have to clip this part of the show out and not produce it. So,
Oh, no. We'll clip it and post it separate.
you get a shadow ban by the all-seeing multi-trillion-dollar corporations of Google. Anyway, all right, Danny. Last thoughts.
But going back, you talked about self-responsibility and really what the lack thereof. If people want people to take care of them, that's a problem, right? We need to be responsible for ourselves, our actions, what we do. And nobody wants to do it anymore, right? That's why get-rich-quick scams are so prevalent, because everybody thinks that, hey, we don't want to put in the work, the time, the energy to do the right thing, and that's the frustrating part. I could go on a rant for a while on this, but that's a bigger issue.
I know. And the other side of this is if we did this, this carbon capture thing, this company wants to do, and we did it on mass scale and sucked all the CO2 out of the air.
Yeah.
What are trees going to survive with? Plants, vegetables, farms.
Well, look, man, Bill Gates has his, what is it? All they're doing is Beyond Meat.
Bill Gates is the largest farmland owner in the United States.
Yeah, but not using it for farming.
No, he leases it out to other farmers.
No. But I think what his intent is different from most, right? Because they're manufacturing actual food,
right? Not
growing food.
Yeah, true.
So it's a little bit different.
That's true. Anyway, all right, that wraps up the show for the day. Get by the website. It's a rant-free website today, by the way. So far. Talked about how the correction had started. That's our Tuesday blog post today. Michael is out today with his post on Janet Yellen and hope that we will not have a recession. That's all on the website right now, realinvestmentadvice.com. Send your questions and comments, of course, as always, to the website, realinvestmentadvice.com. And make sure and subscribe to this channel as well as our Before the Bell channel. That's our new channel for 3 minutes on markets and money. So make sure you subscribe. Just click that little bell icon. All right, have a great day. We'll see you back here tomorrow to talk about the Fed, inflation, and, of course, where do we go from here as the Fed's next meeting is not too far off as well. And what that's going to mean for rate hikes then. All right. See y'all tomorrow. Have a great day.